Hello and welcome to the SIA Wealth Management February 2023 Market Outlook. My name is Colin Cieszynski, Chief Market Strategist. Often in our monthly updates, we like to answer questions from advisors. And the reality is in the last month that we've really had variations on one question coming to us from advisors. And essentially it boils down to 2023 has started off on a positive note for equities and other markets. And is this a bear market bounce or the start of a new bull market? We saw in 2022, we were in a bear market that had a series of bear market bounces that ended up failing at lower highs, and then markets continued downward. This year, however, has been there's some cases that you could make the case for both a bearish outlook and a bullish outlook. So we'll look at a bit of both. The bearish outlook being, oh, it's just another dead cat bounce within an ongoing bear. Nothing to see here, move along. And then there's the bullish case, which says, well, those stocks have legitimately turned upward and have started to climb a wall of worry. And the bottom line, which we'll also look at the end, is that no matter what comes our way, it's important to not be complacent. Tactical investing remains key. We need to be ready to take advantage of opportunities if the markets remain bullish and manage risk if markets turn bearish once again. So we're going to start with the bearish case for markets based on some data that we've seen based on the series of sector performance, interest rates, market momentum. This is a chart that Goldman Sachs put out, and it's an interesting one. It looks at a lot of different themes out there in the markets, and basically on the y-axis vertical we have the 2023 return. On the x-axis, the horizontal, we have the 2022 return. And essentially what this is telling us is that various themes of investing that performed well in 2022 have not performed as well in 2023. And likewise, that things that were the worst performers in 2022 have tended to be some of the strongest performers in the early part of 2023. And that suggests from a bear side that, well, this was just a dead cat bounce. It was perhaps just a dead cat bounce. It's the most depressed sectors bouncing back, and that's about all. And so that's what this chart is suggesting here. So this is indicative of a more bearish case looking forward, was, well, what happens once the bounce is done? And that's really a lot of the questions we have moving forward here. Another one is that a lot of the declines in 2022 were driven by the fact that central banks started to tighten interest rates in a very meaningful way. And we've seen this from starting in late 2021 through all of last year and into this year. And the most important thing is that, with the exception of the Bank of Canada, who actually did pause after their latest rate hike, all the other major central banks in the world are continuing to raise rates. The Fed has already raised rates, the ECB, the Bank of England, all raised rates since the Bank of Canada meetings. So we have seen things continue. And in fact, the Fed, which started out a little bit behind the Bank of Canada, has now officially passed the Bank of Canada in terms of tightening and interest rate increases. So that hasn't gone away. And even if we do have the central banks pausing rate hikes, the quantitative tightening continues. And just as it took a number of years to build up the balance sheets, it'll probably take a number of years to unwind that as well. Another thing to consider, and this is a chart that we highlighted in previous presentations, is that it tells us a couple of things. First of all, in terms of interest rate peaks, we've looked at a number of peaks over the last 50 years, and generally speaking, the Fed funds rate didn't peak until it was higher than the US Consumer Price Index, and I'll speak to that a little later again in the presentation. The second thing is that even after rates peaked, did not tend to be, it was tended to be sometime afterwards that the markets actually bottomed out. And then the case was often that the raising of interest rates was the slowing of the economy. And then when the economy slowed, a collapse in corporate earnings dragged down the stock market. And that's kind of the thing. So if we looked at the Fed funds peaked in June of 2000, that was actually after the Dow Jones peaked in December of 99. The US market didn't bottom out till September of 2002. Similarly, Fed funds peaked in June of 07. The Dow Jones peaked in October of 07. It didn't bottom out till March of 2009. Fed funds peaked in April of 2019. The Dow peaked in December of 2019. And because it was very devastatingly fast bear market that bottomed out in March of 2020. So far, we are still at a we're still basically looking here at the Dow Jones peaked in December of 2021. Fed funds have not yet peaked. The Dow Jones most recent bottom was September 2022. Maybe it's the end of the bull market, maybe it's not, we don't know. So that's why I say for now, because there is the possibility that since Fed funds haven't peaked, that the Dow Jones may or may not have bottomed. We don't really know at this point in time. And now we look at our seasonal chart, which also makes us wonder a little bit about the what was happening with the January bounce. If we look to December, and I'll start with the red lines and the blue lines. So the blue lines are the 25-year monthly average for the Dow. And it shows that the markets do okay to start the year, pick up March, April, May, June. June is historically a weak month. July is historically a rebound. August, September, historically the weakest time of the year for stocks. And then they kind of bounce back into the end of the year. That's been the historical seasonal trend in markets. What we see here is that 2022 kind of more or less followed the same seasonal patterns, but to a much larger degree, to a much more volatile degree. We look at June, normally a month of a small decline, had a huge decline. July, the month of a historic moderate rebound, had a big rebound. August and September, big sell-offs. October, big bounce. And a couple of months that went the opposite direction. One was April, and most notably, the other one was in December. What seemed to have happened in December was tax loss selling seemed to be much stronger than usual, most likely because a lot of people had tax losses out there to take. And once we got past the tax loss selling deadlines, markets started to rebound. So it's possible that if we now look at the green bars, January was particularly strong, not just compared to the blue historical average, but also compared to January of 2022. And so that's important because we saw a big bounce in January, unwinding the big decline we had in December. So that's a possibility there. And then if we look into February, the markets are up a little bit less, a little bit more moderate. So where we're kind of at in February is we're up a little more than average, and certainly doing a lot better than last year, but not quite as well as in January. So the question we ask ourselves here is, has the New Year's rally started to fade? And if so, then what next? So potential for bearishness if this rally continues to weaken. On the other hand, this also shows us that February has not been so bad compared to historical measures. And so therefore that may also be seen as a bullish case as well. And that allows us to segue now onto the bullish side. So there's still a pretty significant bullish case for markets out there, even though there's been a couple of flags here and there. For the most part, there's still a number of indicators that tell us that there's still a bullish case for markets out there. And so the first thing we'll mention is, of course, we're still in the presidential cycle, year 3. And historically, that has been the most positive year of presidential cycles, the third year of the term. And comparing that to the year 2, which is historically the weakest year of the term, often a negative year, a year, certainly last year was definitely representative of a year 2, and year to date we've seen has been representative of a year 3. So so far so good. Something else that's interesting, just to note on that, is that if we look at the October 22 bottom, actually fairly somewhat closely actually mirrors the 2002 bottom. You had and I'll speak to that in a moment. In fact, I'm going to speak to it now, with the S&P 500 head and shoulders base and golden cross. We saw last year that the head and shoulders pattern formed over the second half of the year. The left shoulder hit in July. The head of the pattern was the bottom in October. We had a right shoulder at the end of December, which was around the time of the end of tax loss selling. And since then, we've broken out, and we've also broken out of a long-term downtrend that dated back to January of 2022. Back in 2002, you had a left shoulder in July of 02, you had a head in October of 02, and because there was a war, you actually had the right shoulder was delayed a little bit to about March, April of 2003. But that was a major market bottom. That was a head and shoulders base. And 20 years later, we're seeing it again. And what's most even more interesting than that is if we look at the 200-day moving average, which is that smooth black line. We saw the 200-day moving average broke in March, April. We had a death cross where the 50-day average went under the 200-day moving average. The bear market rallies of August and even in the early December both failed right near the at or near the 200-day moving average. As I said, now we've broken out of this head and shoulders base, broken out of a long-term downtrend line, broken out over the 200-day moving average, and most importantly of all, we've had the confirmation signal that the 50-day moving average, which is the green line, has broken out over the 200-day moving average. That's a golden cross. That is historically a bullish confirmation that an uptrend has started. And what's even more important and interesting about this is that it's not just in the S&P 500. We've seen this looking at sectors, indices and ETFs. We've seen this looking at individual stocks as well. Golden crosses all over the place. That is indicative of a broad-based market turn and can be seen and considered to be extremely bullish. So that's a very, very bullish case across the board. And what's, as I look at this now, I'm now going to shift and look a little bit at, well, what's happening with Dow theory. Dow theory has been around for well over 100 years now. Dates back to writings of Charles Dow, and the idea is that the industrials, companies that make products, and transports, companies that move products should both be heading, generally speaking, in the same direction and confirm each other. So we had a downtrend in the Dow Jones Industrial Average. We had a rally November, December, and it's since pausing, consolidating at a higher level. The Dow Jones Transportation Average had also had a nice recovery through October to December, had a correction into January. It has rallied and broken out again. So we're seeing that the industrials are pausing at a higher range. The Dow Jones transports have broken out. And to me, that's indicative that investors are anticipating an improved global economy this year, and markets are starting to reflect that. And the driver of that is really the reopening of China. That's been one of the big themes coming into this year. The second half of 22 especially saw a lot of things get dragged down because China had gone with additional lockdowns. That's now over, and as the economy reopens, it's providing a boost to the global economy as well. Another interesting thing that I've included here is also the Dow Jones Utility Average. And this is, utilities are two things. They're sensitive to interest rates and to a certain extent, and they're also one of the most defensive sectors out there. They're one of the most steady sectors out there. And so we saw in the early part of, in much of 2022, that when other markets were really getting hammered, the utilities held up reasonably well on a relative basis. But now we're seeing, as we go into 2023, as investor confidence has improved, as capital started to return to the markets and moved in more looking at growth sectors and cyclical sectors again, that utilities are starting to roll over. And we're seeing that in other defensive sectors as well, that the defensives are starting to underperform a little bit this year, whereas the cyclicals are outperforming. So this is more confirmation of a shift in investor sentiment. As I mentioned, one of the most important things that we're also seeing with the current equity market rebound is breadth. In the later part of 2021, before the bear market really got going, towards the end of 21, a lot of things had kind of topped out, and in the case of international markets, even were already starting to go down. In the case I look here at the emerging markets ETF as example, peaked in March of 2021. The S&P 500, the gray bar line, was peaked in January of 2022. So a number of international markets were already under pressure as an example. And so the latter part of 2021, yes, US indices were rallying, but that was being driven by a small number of large cap stocks. And no surprise, that kind of came to an end and we went into a bear market. But now we're seeing breadth across a number of areas that I'll highlight over the next few slides, showing a broad-based market upturn, which is quite important. So in this case, we look at international markets. The black line at the bottom, emerging markets. The purple line, the EFE, developed markets. The orange line is all country world index except US. The gray line's S&P 500 and the blue line is Canada. So this shows that so far we've seen a particular turnaround in overseas markets, although over the course of 2 years, the US and Canada are still outperforming. So now we look at what's happened over the last 6 months. Well, we can see back in October, everything bottomed out. And needless to say, because they weren't down quite as much, the US and Canada have not bounced back quite as much as the rebound we've seen in international markets. Developed overseas leading the way. Emerging markets had been keeping up until the last couple of weeks. And so overall, we have been seeing quite a bit of strength across international markets. And another sign of strength in international markets is the first new high since the bear markets started about a year ago in earnest, and really one of the first new highs. And so since the US market peaked just over a year ago, the FTSE hit a new all-time high last week. And this is particularly important. It's broken out, as we can see. And so when we start seeing markets hit new highs, indicative of a new bull market getting underway. Now, in the case of the FTSE, the bar was a little bit lower than some of the other markets because the FTSE actually peaked back in 2018, and the rebound of 2020 to 21 did not get to new all-time highs for the FTSE as it did for the DAX and Toronto and the US indices. So yes, it had a lower bar to climb, but the point is that it has still broken through it, and that's important at this point in time. Another thing, as I mentioned, towards the end of 2021, it was just a few large cap stocks. So we look at the small cap stocks as well. And here the Russell had kind of peaked a couple of months ahead of the S&P. It peaked in about October, November of 2021, and then really came down. And we saw in the second half of last year, the Russell kind of bottomed out and stabilized, but it hadn't really turned upwards. But it has now in the last few weeks. It's broken out of a downtrend as well. So small caps confirming the upturn in large caps is also a bullish sign. And also just to show breadth across sectors as well is really important. The most important thing on this chart is to look at the year-to-date graph on the right-hand side. Every single one of the 11 major industry groups is green. And so that's showing us that this is a broad-based recovery in everything. And it's not just the growth stock areas leading the way. It's not just tech and communications that were more depressed bouncing back. It's the core cyclicals are also right up there, the consumer discretionary and the industrials. And seeing those move is indicative that this isn't a liquidity play. It's investors anticipating an economic recovery play. And that's important. And financials are right there as well. So that's actually quite a positive sign of breadth. And it's interesting, like we look across at the 1 year, we can see it's all over the place as an example. But year to date, even the 3 months is generally showing that markets are recovering. And as I say, it's the cyclicals that are leading the way just as much as the more depressed growth sectors. Another factor helping this is US inflation pressures are continuing to ease. I mentioned earlier in this presentation that historically the Fed has not stopped raising rates until Fed funds was above CPI. So the orange line and that starts at the bottom is Fed funds. Actually, I guess it's yellow. The blue line is CPI. The orange line is core PCE inflation, which is the measure the Fed uses. And hourly earnings, the gray line, is indicative of wage inflation. So what we've seen now in the last few months is the Fed funds has climbed above PCE, it's climbed above hourly earnings, wage inflation pressures easing is particularly good, and it's starting to catch it, getting close, but not quite there yet to CPI. When we consider that a year ago, CPI was up at 7-8%, the Fed funds was down at 0, and we'd think, how are they ever going to meet in the middle? Well, they're getting pretty close. With Fed funds getting close to 5 and with CPI just above 6, they're getting pretty close to meeting in the middle, but it does indicate that the Fed does still have a little bit ways to go in its fight to get inflation back under control. And the other interesting one was we had a headwind for US dollar last year that is fading. That big ramp up in interest rates drove the US dollar up against everything. And it really put a headwind in front of everything else. Whether it's commodities that are priced in US dollars, other currencies relative to US dollar, and it's a drag on corporate earnings. A rising US dollar hurts US multinationals and hurts US exporters, which tend to be among the majority of companies in the biggest indices. So it also ends up putting a headwind in front of US indices. Now that this chart shows since October, the end of September, where I put this vertical line, this has reversed. Since September, October, the US dollar peaked and has started to come down. And what have we seen since then? Copper, the black line, recovering. International equities, the orange line, recovering. S&P 500, the blue line, recovering. And purple, gold, we've talked at length about how in most of 2022, gold really did keep up its role as a store of value. It outperformed against all other currencies except the US dollar, because the US dollar steamrolled everything. Well, now that the US dollar has started to back off, gold has absolutely taken off in US dollar terms as well. So we've talked about the bearish case and the bullish case, and now we move to the bottom line, which is that a tactical approach to investing remains important and critical as we move forward. And we look here at the SIA charts equity action call, particularly here on the right-hand side. We could see it spent most of 2022 in the yellow zone or the red zone, indicating neutral to underperformance of equities relative to other asset classes, in particular cash and currency. Right near the end of 2022, we saw this improve in the last couple of months. We went back into the green favored zone, which is a macro measure of global equity market risk and money flows and price action changes. But it's indicative that equities have started to outperform relative to other asset classes. And at this point in time, it remains in the green favored zone. So that's a bullish sign. And since then, what's important, we look here, as we've shown the ups and downs of the equity action call, is that in the portfolios that SIA Wealth manages and sub-advises, we've made a number of tactical changes over the last couple of years. As market conditions started to deteriorate over the course of late 2021, early 2022, we went for over an 18-month period, went from almost 100% equity in January of 2021 to 0% equity by June of 2022. As we saw selected opportunities appear in the markets over the second half of 22, we had a couple of periods where we moved into 50% equities and then back out as market conditions weakened. And then as we moved into the fall, we went to a 50% equity position in November and then 100% equity position by the end of November, where we've remained since. So this is indicative that as market conditions change, SIA Wealth is prepared to change as well, and is prepared to move and take action as needed when risk is on, full speed ahead, and with relative strength and taking advantage of opportunities. And if we end up in another risk-off market or another correction or what have you, we're prepared to take move off the table and raise cash once again. And just to finish up, over the course of the last month, I had a couple of other interesting things that struck me that didn't really fit into the theme of, is it a bull market or is it a bear market? So I did just want to highlight those now. The first one was comparing sector weightings across markets, and this kind of came to me when we saw the FTSE breakout last week. And as we kind of speak to how there's significant difference in weightings between the US and Canada and the UK, but it's another thing to actually quantify it and see it. So when we look at the US market, in particular, it has a particularly high weighting to healthcare, technology, and communication services relative to other markets, and a relatively low weighting to energy and materials in particular. In Canada, on the other hand, it's almost the opposite. We have a higher weighting in energy, materials, and interestingly, industrials, and a lower weighting in technology and communications. What was most interesting about in Canada is just how much financials are a part of the Canadian market. 36% of EWC at the end of December. So financial, that's the banks and the big insurers, are a huge chunk of the Canadian market, especially relative to some of our peer countries out there. The UK has a higher weighting in energy and materials, similar to Canada. It seems as though most of the big miners and energy stocks, if they aren't listed in Toronto or New York, tend to be listed in London. And but the big one that was interesting of the UK is just how much a significantly higher weighting than everyone else in consumer staples, and a significantly lower weighting than everybody else in technology and communications. That was intriguing. And then when we moved over to Germany, what was particularly interesting there was its highest weighted sectors are consumer discretionary and consumer staples, and in fact in Germany is the other outlier is the very extremely low weighting to energy, as in zero, in the German market particularly compared to other markets. And the last slide I wanted to take a look at here, we've looked at this a few times and been watching this as it evolves, was the crude oil versus oil stocks. Between 2020 and 22, and for the most part over the longer term, crude oil and oil stocks tend to follow a similar direction of travel. However, the crude oil price has sometimes been a little bit more volatile, and you've seen a down spike in 2020 and an up spike in 22, which was eventually resolved by the oil price coming back into line with oil stocks. But over the last 6 months or so, it's been very strange. We've had this huge gap in performance open up between crude oil, which is the gray line, and oil and gas stocks, which is the orange line. And there was one attempt to close it back in September, but since then, we've seen this gap has just remained wide open, and it hasn't really narrowed either. It hasn't expanded. It's just still kind of there. So it's something that we're continuing to monitor and keep an eye on as we move forward. So now we'll just highlight here are the fund codes and sales information. These are funds from BMO Global Asset Management, of which SIA Wealth is a sub-advisor. And finally, we will finish with our disclaimer here. So on that note, we'd like to thank you all very much for joining us this month, and we hope you all have a great day.